So we got the Jackson Hole event finally, and we heard from Jerome Powell. He came out, and the most important thing that struck the markets right off the bat was the word where he used carefully, right? What does this mean, carefully? Well, he said the Fed will proceed carefully when deciding to hike again or hold steady. And that caused bonds to rally, stocks to rally, thinking that, okay, this is the pause, this is the pause, this is the pause. However, stocks and bonds reversed that rally very quickly as Jerome Powell went on discussing the same thing that he said during the last FOMC minutes. So, in other words, you could argue that there was really nothing new there. There wasn't really so much of a dovish tilt other than the carefully word. And he still remains adamant that we got to get to the inflation target of 2%. So what does this mean for the markets? What does this mean for the economy going forward? And also with interest rate hikes. Now, before I start, my name is Daniel. I run an organization called Infovest. Infovest is an organization that promotes financial literacy, teaches you about investing, trading in the markets by utilizing macroeconomics. I have courses on it if you're interested. Just visit www.infovesting.com and all the details are there. Now, let's get into it. There's a couple of things that Jerome Powell said. Let's start off with a few comments here. So Jerome Powell said we will decide the next move based on data. Okay, again, something that we've heard before from Powell. We're going to be data dependent. So in other words, we've got data coming up in September. So that September data, if it comes out to be hotter than expected, then guess what? Yes, you're going to get the Fed to react accordingly. Now, if not, then, there could be that pause, right? Until there's something new that comes up and pops up in terms of the data for the market. Now, he also said we'll decide the next move. So didn't hone in any decision that, hey, we're going to for sure pause, we're going to cut, obviously not a cut, but he didn't leave the door open for he did leave the door open that they could pause in September, because he said we will decide next moves based on data. Based on data, maybe they hike, maybe they don't, right? So obviously also left the door open for a possibility of some sort of hike. And again, it's all dependent on how hot the data comes in, the economic data. Now, on top of that, it says Fed is attentive to the signs, economy that's not cooling as expected. So again, hawkish comment there. The economy is not cooling as expected. It's still doing well, robust. I mean, just look at, the Taylor Swift concerts, this, that, traveling, right? People are still spending money, vacations, and so forth. So, not much signs of cooling there. Inflation remains too high. That's expected. Fed will not change the 2% target, right? They're not going to go to 3% and say, oh, this 3% is now the new area. No, they're adamant at 2% though. And like I said many times in the previous videos, they are going to go after this 2% target. Now, it says policy is restrictive, but Fed can't be certain what neutral rate level is. So, yes, we're in restrictive territory, but that doesn't mean that it doesn't end there, right? Neutral rate could be further up, or maybe it is, or they passed it, right? We don't know, and the Fed doesn't know, right? So that means that, the door is open for further rate hikes, and even into next year if the data continues to be stronger and the growth in the economy continues to be stronger and stronger and stronger. 2 months of good data are only the beginning of what we need to see to build confidence on inflation path. So that's very interesting. So they want to see 2 months of good data. They're saying 2 months of good data are just only the beginning to build confidence on this inflation path. So, you're seeing inflation come down, but it's not a win yet. Signs of job market not cooling could also warrant more Fed action. Okay, this is the most important line. There's actually a couple of lines on the job market that the Fed talked about. So I'll explain, I'll say the other ones. Lowering inflation also likely to require a softer labor market. Sees evidence inflation becoming more responsive to labor market. Okay, right there. 3 main important bullet points you really need to understand here. The Fed is basically telling you, in order to get inflation down, they will need to have to come after your job, basically. You'll need to come after your job, need to come after jobs. The labor market needs to get worse off. That means there got to be job losses. So basically saying here, lowering inflation, let me say it again, lowering inflation also likely to require a softer labor market. So in order to get inflation down, there's got to be job losses, right? And I said this in the previous videos as well, where I said, okay, if you got the unemployment rate spiking, got the job losses happening, that'll probably have demand to a complete halt, and you'll have less consumer spending. Consumer spending is a big component of GDP. Businesses are going to feel the pinch. They'll cut the prices, and that's how they will probably try to aim to attacking inflation. So really, at the end of the day, now Jackson Hole is an event where it happens once every year in August, end of August. And a lot of the central bankers out there come out, they discuss monetary policy. You had also other Fed members come out, discuss monetary policy, kind of mimic the same thing that Powell was saying, and same thing from the FOMC minutes. And you also have other central banks out there internationally, like for example, the ECB, Lagarde, and so on. So it's really important event because you get to hear monetary policy and the views from all of these central banks. But it's going to be the Fed, all right? And I said this before, it's going to be the Fed to tackle inflation. It's not going to be ECB, Bank of Japan. It's not going to be Bank of Japan. It's not going to be Bank of Canada. It's not going to be New Zealand. None of these places. It's going to be the Fed. The Fed's got to attack harder and harder and may continue to be more in tightening mode than the rest of the countries out there, and the rest of the other central banks out there globally, right? So they're going to have to tackle it because the US dollar is the world reserve currency, right? And as we're seeing right now, especially today, the dollar has been moving up. So when you get the dollar to move up and move up, it does create pain for a lot of countries out there, like we've heard previously a year or two back for certain countries out there, like for example, take Sri Lanka, who was having a big issue with their own currency, right? Who have debt denominated in US dollar. So same thing with a lot of countries out there like China and so on, who have debt in US dollar, right? Or who are issuing also. China's a big issuer of debt, which is also to other countries, the smaller countries in US dollar. If those countries start to fail and China's already feeling the pain of recession within their own country, globally, the U.S. can single-handedly cause pain throughout the world because they continue to keep conditions tighter. U.S. dollar continues to move up higher. There is a shortage problem when it comes to the U.S. dollar, and that is going to create that tightening condition for many of the countries and pain for a lot of consumers and the world globally. So you could see a global recession. And probably the U.S. would be maybe the last to cut if nothing is breaking within their own economy or something, or if there's not a very big telling sign, right? So it's very important. And you hear it from the Fed, they're holding their stance on the 2% target, and they just told you in this event, right? They told you, in other words, how I'm basically rephrasing it, they're coming after jobs, and they want jobs because if they can you know, soften the labor market. They use these nice words, soften, soft landing, blah, blah, blah. But if you look at the probabilities, very low chance of a soft landing. Usually you tend to see hard landings happen. It's very hard to engineer a soft landing. So you tend to see a hard landing, and then you do see unemployment rate skyrocket. You do see job losses. And I believe the Fed will engineer that. The Fed will create it. The Fed will continue to be tight for a very long time, or maybe even hike rates further if the economy continues to be resilient. If not, then they can pause, then they can relax. Also, listening to the Fed, it seems here that they would be more inclined to also tightening into a recession, or in a recession as well, because again, their target is the 2% target. So if you've got the recession and the inflation target's not met, and that means that, you know, you keep conditions tighter until they are. So that's my 2 cents on reading and watching, you know, the event, Jackson Hole event, and what Powell said. It's very interesting that, you know, the market, stocks and bonds went up, and then afterwards they sold off completely. However, closer to the end of the day, you did see stocks pick back up, and bonds as well, basically shrugging off the event, right? Another very interesting thing too, a day before that, after NVIDIA's earnings, you did see the stock market completely plunge, right? So that's a very telling sign that especially, you know, with strong earnings, that the price action is very, very bearish. Now, the fact that we bounce back up here for the Jackson Hole, it'll be very interesting how this plays out in the coming days, and September is going to be really important, right? September, right now it's the end of August, people are on vacation, institutions, head traders, etc., etc. So they're going to come back in September, reassess the situation, and the data in September is going to be key, because if any of the data comes in way hotter than expected, it can really shake up price action and the markets. You could maybe see continuation of the sell-off. If not, if everything looks good, then hey, you know, you might see a relief rally and so on. So it's going to be really interesting how it plays out in September and in the coming days. So until then, enjoy the last week of August, and I'll see you guys around. Cheers. Bye.